Okay, so welcome everyone to Quarterly Conversations. As Rick said, this is our 11th straight quarter that we've been doing this, and I think so far to great success. I certainly enjoy it. So we have a jam-packed day here. So Rick, you want to get us started?
Absolutely. I'll just start off by saying this market closed down. It was we come up off our lows quite a bit this afternoon, but we closed down about 110 points. Earnings season seems to be kicking off where everybody expects it to be, and along with our labor rates today, our job rates, employment rates came out today, and we're up a little bit in jobless claims too. So there's a lot going on in the market. I think it feeds right into your letter, Dan. You did a great job on setting the letter up this quarter. It's going to be a lot of interesting conversation today, I believe. So why don't we start off with what we're going to cover, and we'll walk through it. So, you know, since the last quarterly conversations, we had a bank crisis on our hands. Where two banks, Signature Bank and SVB, which is Silicon Valley Bank, decided that they were going to collapse, and that kind of threw a spoke in the stick in the spokes for the quarter starting off this particular quarter. But this is becoming a slow rolling crisis for the U.S. banking system, because the Federal Reserve and the federal government decide they're going to start backstopping some of these issues that are coming about with banks. So we're going to talk a little bit more about that. Inflation and interest rate policies. You know, there's a lot going on with what's going on with inflation today, what the expectations are with interest rate policies. One of the things that I just mentioned that came out today in payroll. That's what the Fed's really looking at, is to be able to slow the rate of change down, and get their hands around and get their arms wrapped around inflation. But it doesn't, you know, the market still is going to be quite unpredictable. We got a long road ahead of us. We're going to talk a little bit about that with slow growth policy, with slow growth potential happening out there. But there's a lot to cover. And Dan, why don't you start us off?
Yeah, so I think you know, one of the interesting things to start the year, we started our January quarterly conversations as well as, you know, heading into the end of 2022. You know, our sort of outlook remains the same, which is it's gonna be a long road ahead, right? And you know, I thought it was interesting how to start the year we had a major pop in most of the markets, and you know, led by technically the NASDAQ, right, which is very interesting. Because that's, you know, typically your sort of risk on trade. You know, your tech stocks in the NASDAQ were up 17.1% in the first quarter. The S&P 500 up 7.5%, and bonds started coming back. The Barclays Ag was up 3%. You know, we listened to a lot of different analysts and you know, economists and commentary, and I thought that, you know, the interesting thing here was that with the consensus viewpoint, you know, of a recession still on the horizon, this is kind of like when, you know, it's sunny skies in the morning, but there's thunderstorms forecast at night, right? So, you know, sitting there in the morning, beautiful day, you think to yourself, how can there be thunderstorms coming? But, you know, that's kind of what this is like. And even on the economic side, it's not like the market is being irrational as it has a tendency to do. You know, on the economic side, all positives. You know, unemployment is up, and wage growth is down, which is actually a positive because of where we are in the cycle. Both, unemployment is still at a cycle low, in fact, a historic low, and wage growth is still at a cycle high. But the fact that there's been some softening in the labor market while it still remains strong is good news, because that's what fuels inflation if you have a really, really hot labor market. So the fact that we see a little bit of softening is actually some good news. And this is from March numbers. Inflation for food, energy, and vehicles is down 2.8%, and GDP is projected to be growing at 2% in the first quarter. So all really healthy numbers, pretty much across the board, no matter where you look. And I think that, to start the year, this is much better than certainly we anticipated. I would say is probably a fair statement, right, Rick?
Yeah, it actually is much better. Actually started coming back sometime in October originally. But again, the big key, I think, is our unemployment, our wage growth, as far as inflation and the Federal Reserve slowing down. And right. I think that wage growth is coming down, which we are seeing signs of that. But it's coming down slightly. Right. So it's maybe not fast enough, but we'll see what the Fed does, because anything that they could change their mind on the last quarterly increase. But we'll see.
Right. Yeah. Okay. I have there is a question here in the chat. I'm going to get to it because we're going to actually talk about. I will circle back on that question. One thing that I think is worth noting. I talked about how the NASDAQ, risk on all across the board to start the year, and the NASDAQ, started off at up 7%. One interesting piece here with some of the banking turmoil, recession on the horizon. Why the heck is the stock market up? Really just peeling back some of that top layer. If you look at the S&P 500, pretty much all of the return came from the 8 what I would call mega cap tech stocks. So you can see down here at the bottom of the screen, it's the FANG plus the Mint. So Facebook, Apple, Amazon, Netflix, Google, Microsoft, Nvidia, and Tesla. If you take those 8 names, they were all up close to 6% to start the year. The rest of the S&P 500 was down here in negative territory. So that is certainly an interesting turn of events that typically what would be considered riskier stocks, more speculative. They're trading on multiples. When you have, banking crisis, recession on the horizon, they're kind of acting as the new consumer defensive, which, I felt was an interesting turn of events on sort of, investor behavior. But ultimately, the underlying story in the market is most of the equity market is flat. So we're going to spend some time here on the banking crisis, because we really think that there's probably more to this than the headlines would lead you to believe. A lot of what I've been reading recently in the journal and just kind of generally in investor publications is sort of like, well, with the banking crisis all but behind us, ... which I simply just I don't believe that, and I don't think Rick, I don't believe you do either.
Neither does our person on the chat.
Yes.
So we'll like you said, we'll touch on that to talk a little bit more about that banking crisis.
Yeah. So just a little bit of background here to give everyone some context. So Silicon Valley Bank, it was the largest lender to fail since 08, 09. Even though it is an historic collapse. Silicon Valley Bank and Signature Bank are, they're comparably small when you consider how large, the Chase and Wells Fargo's of the world are, Bank of America, Citibank. I mean, the behemoths are just massive. So these are comparably small banks. I think SVB was the 15th or 16th largest bank in the country. So, still big, but nowhere near as large as the big boys. And ultimately they weren't too big to fail. And you read a lot about moral hazard and FDIC insurance limits. About 90% of the deposits at Silicon Valley are not FDIC insured. So I think there's a lot of discussion around, should the Federal Reserve, should the Treasury have stepped in just from a moral perspective, meaning, if depositors now just assume that anything they put in the banking system is going to be backstopped, then ultimately we've just gotten to a point where we just have one bank, and that's the Federal Reserve. But ultimately they took the tactic of no bank is too small to care, even though they may not be too big to fail, simply because they regulators are very concerned about contagion. And ultimately, our gut reaction, and something that we've heard out there, is the level of intervention that was put forth for these failing banks, not only the level, but how swiftly the interventions happened. It's essentially one of two things. It's either this was an overreaction, or the banking system itself is worse off than we have been led on to believe. And those sort of maybe in the know have more of a viewpoint of this is a bigger problem. But ultimately it has to be one of those two things, because these were like crisis level interventions. And for the 16th largest lender in the country, technically this was not a too big to fail issue. So to me, this says that these problems kind of run deep.
Yeah, I think the biggest thing they were worried about is a run across the board. So they came in and backstopped the loans that not the loans they had, but they backstopped the depositors. Because I think if I remember correctly, Silicon Valley Bank had over $265 billion above the FDIC insurance. And
Right.
And I believe First Republic had quite a bit as well. Signature Bank had quite a bit as well. So they did come in and stop slowed it down, at least for the time being. But yeah, it's going to be interesting where they go next. And I believe then that that backstop, so they opened up a window for lending as well. So any banks that are having a problem can pull a loan from the Federal Reserve, and I think that goes away March of 2024.
Yeah, it was a 12-month thing.
Okay.
And actually that window. So yeah, we'll talk a little bit about that. But one of the things with SVB that we keep reading that they were uniquely exposed to these issues, and ultimately, what was happening is if you look at a chart of their deposits, it just all of a sudden falls off a cliff. And they had a bunch of
I would put quotes around uniquely.
Well, okay. Yeah. Ultimately, they were the bank for startups, right? And that was their depositor base. So you had a bunch of startups. Capital was liquidity was created at a historic pace during COVID. Most of it sat on the sidelines, and a lot of it ended up going into startups and private investment. So a lot of these kind of techies, these tech startups, put their money with Silicon Valley because that's sort of how they position themselves. Well, the problem is as the tide started going out, you had these large tech companies sitting on massive uninsured deposits, and they just started moving gigantic amounts of cash out all at once. And they ultimately couldn't keep up with it. And the fact of the matter is, Silicon Valley is suffering from the same problem that the rest of the banking system is suffering from as well, which is they have a ton of losses sitting on their books. Right. So I've found a study from USC, University of Southern California. They went through the whole kind of banking system to look at balance sheets of banks. And what they found is typically just sort of a quick 101 on how banks invest money on the at the highest level, right? Is that, you know, take deposits. Banks are typically conservative, but, you know, they're taking deposits. They're using those deposits to lend out funds, and they're buying treasury securities. Well, we all know what happened to interest rates over the last year. They spiked up aggressively. So for all those treasuries and all those loans that were written prior to a year ago at near zero rates, all of a sudden, all of those loans and all of those treasuries that the banks bought are worth a lot less than they were a year or two ago. So it's about approximately in aggregate across the system, there's about $620 billion of unrealized mark-to-market, meaning treasury losses if they had to actually use those treasuries to meet deposit redemptions, and over $2 trillion in unrealized losses on fixed rate loans. So if you think about it, if you got a mortgage 2 years ago and your rate was 2.5%, 3%, and now the bank is lending out money at 5%, 6%, well, all of a sudden that mortgage that they wrote for you, that's, you know, whatever, 15, 20, 30-year mortgage, that's all of a sudden worth a lot less to the bank because they're now writing mortgages at 5%, 6%. Conversely, the deposit base is worth a lot more for the same reason. So the fact of the matter is the banking system, their balance sheets look a little bit off, meaning those loans and those treasuries are worth a lot less than when they bought them and appear to be at a massive loss. But then their deposit bases look very healthy because now that you're earning interest on savings accounts and CDs and et cetera, the bank is getting a spread of that. So those deposits ultimately are worth a lot more. So they offset, right? Problem with that is that if, like Silicon Valley, that deposit base starts to drain and that part of your balance sheet that's worth a lot more, those deposits start to go out. Well, now how do you cover those withdrawal requests? You're going to have to sell all of those things that are at a loss. So it's kind of like if you bought a house in 2007 at the peak of the market, and then the bottom falls out and your house is worth less than your mortgage. Guess what? It doesn't matter if you have enough cash flow to keep making the payments and you can just hold on to it for 10 years. But if you have to sell it, then it's a problem if you don't have the cash flow to cover it.
Yeah. So if you look at what they did, they hold certain amount of securities to maturity, and they don't have to market those securities.
Right.
So and if they drain their deposits too far, when they do go and sell some of those securities that they were expected to hold to maturity, then they have to ultimately claim the whole mark-to-market for the whole group of securities at that point, I believe.
Right.
So that's, you know, if you were to sell your house, it's like now your house, the fact that you took a loss on your house actually means something.
Now it actually, right. And the thing is that the bigger institutions, and there's I've also read about this a lot. How, well, no, the banking system is well capitalized. It's well capitalized. Regulations changed after 2008, which is true. They signed Dodd-Frank into law. We looked it up, 2017, 2018.
2018, Dodd-Frank changed
They
with the
yeah, they
support
changed. So
of Barney Frank.
yeah, so basically what Dodd-Frank was, just a quick primer, is Dodd-Frank was required that US banks had much higher capitalization ratios, meaning essentially, again, just kind of comparing this back to a real estate property. It's kind of like saying your loan to value can't be 90%, it has to be 80%, or it has to be set, right? So the lower that is, the more capitalized you are in that asset. What Dodd-Frank did is it increased the amount of capitalization banks were required to have after the 2008 crisis. 10 years later, in 2018, they changed Dodd-Frank. They changed the minimum amount of assets to where you have to adhere to that stricter capitalization requirement. It went from 50 billion to 250 billion. So now those banks that previously had to adhere to those more strict regulations for the last 5 years haven't had to. And SVB being one of them. So you have all this swath of small to mid-sized banks that have taken on more deposits without needing to adhere to strict capitalization requirements. And what I mean by that is, one of those requirements, the easiest one to think about, is when Chase goes to regulators to make sure that they're quote unquote well capitalized, they have to mark their whole treasury book to market. So in other words, those losses, they don't do it in real terms. But when the regulators say, are you well capitalized enough? Chase has to say, well, look, we're sitting on $100 billion of treasuries that we bought 2 years ago. And the regulator says, okay, well, those are actually worth 80 billion now. They don't have to realize any losses, but from a capitalization standpoint, they have to actually show that they're worth less. Small to mid-sized banks don't have to do that anymore. And the issue is, now that they're not doing that, you have places like SVB that are not adhering to the same standards. And if they are serving a particular type of customer base that is potentially, transient or may need large chunks of liquidity, flight risk can become an issue. And to go to the question of it says anonymous attendee, so I'm not sure who asked it, but of the person in the chat, talking about corporate real estate, one of our concerns is actually when corporate real estate gets squeezed, if there's a small to mid-sized institution that is holding a ton of deposits and rentals start drying up and they start pulling, capital out of the banks, if the banking system or whatever that small to mid-sized bank may be that has a lot of, corporate limited partnerships that hold real estate or what have you, and they start chunking out funds because rent is drying up, you'll figure out who's swimming naked when the tide goes out.
Yeah, and that's interesting.
We just don't know who that is, right? I mean, it's impossible to know.
And the snowball is beginning to roll downhill. When we passed the first of the year, Twitter actually defaulted on their leased space after the first of the year. Following shortly behind them was PIMCO. PIMCO has a private REIT that they filed or they defaulted on $1.7 billion worth of office space, AAA office space. And I believe BlackRock was another one that did it. But these are all non-bank entities, not necessarily. Obviously, it affects the holder of that private equity or that private REIT. But it doesn't. This particular doesn't affect the banks. But like you said, Dan, we don't know who's swimming naked till the tide goes out. Over the next, where are we? 2023. So 7 years. There's 330 million square feet of office space that's going to turn. And a lot of that comes in this particular year. The largest chunk over the next 7 years comes in 2023. So we should start seeing cracks in that, and who's swimming naked at this point in time as we come towards the end of the year. That's a fear that we have. And
Yeah, I think that's, that's more of a, right, what happens if, and it's I think the best analogy for the banking system is it's kind of like it's not a ticking time bomb, it's not a bubble. I think the best analogy is it's more like a dormant volcano.
I think you related it to zombie banks too, I think, in the letter, right? So
yeah, that zombie banks is like the colloquial term for it, like essentially meaning they're keeping capital tied up in unproductive assets. And that type of an environment was last in the US in the 80s. And if you look at a chart, I wish I had this, I should have put this in here. If you look at a chart in the 80s was a decade of essentially like markets went up, markets went down, but you had a decade of like no returns pretty much. And it was just, if you were just in the market, your only return was really your dividend, ultimately. Right. That's where your return came from, was just the dividends on your stocks. The market itself didn't really grow all that much. And that was ultimately in the 80s because of this, I wouldn't call it a banking system, catastrophe, but it was after a period of the yield curve being tortured by interest rate policy and inflation that kind of runs out of control. This typically is what happens because the banking system is sitting on all of these notes that they wrote, this debt that they wrote, and these treasuries that they bought over the last couple of years. And now all of a sudden it's not doing them any good. And typically what ends up happening is, this is where the recession comes in. Typically the banks have to lend less because of this.
mm-hmm.
They can't take as much risk. But
ultimately
that's why it's a dormant volcano, because this may never be an issue. There may not be any other banks that collapse. But we know there is a systemic problem that is the case at every bank in the country, which is the same thing that was not necessarily unique to Silicon Valley Bank. It just ultimately, that's where it started to crack. And the volcano may not erupt again, but we know that it's there.
Yeah.
Right.
And then and it's very possible that office space, a collapse in the office space real estate could potentially affect the banks.
Well, that's why I brought it up with that question, because I think ultimately with office space, that's where it could become a problem, is I think it could bleed back to the banking system.
Yep.
So
let's move on to inflation.
Yeah. So this, again, going back to the 80s, because we're talking about similar things and that kind of lost decade. There's some good news here. And I think that ultimately this is what the market is seeing. This is there's a lot of stuff here. So I'm going to try to make this as easy as possible. The March inflation numbers just came through, and inflation softened down to 4.9% for March. The way that in the inflation data works is that it's all of the last 12 trailing months of inflation. So if you were to add up these numbers for every month over the last 12 months, you get 4.9%. And obviously the March number is reported in April is reported in May, et cetera, et cetera. Specifically, what we highlighted here are 2 months from last year, May and June of 2022. Inflation came in really hot. And right now we're seeing that in April, The current kind of consensus estimate here is this 0.4. And as essentially inflation appears to be moderating. So if we kind of assume it stays around that same level, which it may go up a bit, may go down a bit, ultimately the trajectory of headline inflation, once these 2 months roll off by the June reading, which will be reported in July, inflation should come down here. Again, depending on what the actual monthly numbers end up looking like, we're looking at like a low to mid 3 number of inflation. And the Federal Reserve has actually said for quite some time that they would live with that. Where target is 2%, but they would live with that 3.
For a period of time.
For a period of time.
And this is why they're looking to keep interest rates lower for longer or higher for longer.
Well, so that's the thing, right? I think that's the major question mark. The market is seeing this. The market is seeing inflation is going to drop off and come back to a level that the Fed is comfortable with. And I think the market is getting hopeful that the Fed will start to ease, right? Meaning they'll start to back off on the interest rates because inflation, they're hitting their inflation objective. My issue with that assumption is twofold. One, the Fed has not said that. The Fed has said we're going to keep rates higher. And two, when you look back at this data here, once those 2 numbers from May and June 2022 roll off, it's going to take quite some time before inflation actually goes down because there aren't any other major spikes in that headline number. In fact, you can see, July, just as an example, was slightly negative. It's possible that inflation actually ticks back up a little bit, towards the end of the summer, right? And I think what you're going to see is the market, inflation's going to tick back up a little bit. The Fed's going to hold, and the market's not going to like that because the market's thinking the Fed's going to cut. But at any rate, the inflation figures that are being shown here, and this is typically what the Fed is looking at, is headline inflation. And I have a question here. Don't we ignore energy and food costs in the inflation numbers? And the answer is headline inflation technically does not ignore that. Headline inflation includes everything. And in fact, the energy and food costs are contributing to the downward pressure on the inflation gauge, if you could believe it, at least of late. The issue, to be honest, with the inflation reading is that shelter is still part of it. And shelter is a 12-month lagging indicator. So, we're sitting here in April 2022. So, a rent or a lease locked in June of 2022, 2023, in June of 2022 is still being reflected in the inflation number. Right. So that's part of the issue with the inflation gauge. Now, the Fed and the policymaking committee, they look at any number of different, this is the easiest way to show it is just headline, but they look at, stripping out food and energy. They call it like the core PCE or something to that effect. So they look at a number of different gauges. I'm just showing you the headline, and ultimately, depending on who the Reserve Board governor is that's casting their vote, or the Federal Open Market Committee member, they all have their preferred gauges, and some of them would rather strip out food and energy because it's the more volatile part of the index. But ultimately, that headline figure is what the Fed has basically said they're paying attention to, and they want to see it. They'll live with it for, Rick, like you said, for some time, potentially running hot, quote unquote, above 3%. The problem is I'm not seeing a way for this to actually get to a point where they're looking to cut rates.
Not anytime soon.
Right. Well, at least
Yeah.
not anytime soon.
And you know, with just to step back into the removal of the energy and food. I mean, it's energy can our gas prices can go up fairly substantially, and that could automatically push food prices up. If you remember, probably about 8, 9, 10 years ago, costs of gas prices had gone up almost into the $5 range, and that pushed the prices of food up just by transportation alone. So although there's not inflation rampant in the system, you got to pull out that volatility, because that's not necessarily caused by us going out and buying stuff because you know, our wages are going up. So that's long-term inflation, is basically wages going up, and then inflation goes up because people are buying more, and then when inflation goes up, they're demanding more money. So it's a constant battle going back and forth. With oil prices and gas prices, that can change on a day-to-day basis. It can change on a year-to-year, season-to-season basis.
Right. And that was one, actually, that's a good point, because that was one of the, you can see here, I know I mentioned at the beginning, see that drop, a lot of that was actually food and energy. And one of the things you're not seeing in the headline number, even though it is softening and going down, is that the core part, like the service, I think it's the services part of inflation is what they call it, is actually increasing. And the problem is with that is, if you strip out shelter and food and energy, what you're left with is an incredibly sticky part of inflation, which is caused by exactly what you're talking about.
Yeah.
Right. And that's the issue, is that even though the headline inflation appears to be softening, a lot of it is the transitory stuff is getting out of the inflation number. And what we're left with is inflation that is incredibly stubborn and hard to get rid of. And I think the Fed knows that.
And that's why their policy for higher for longer is expected to be in place for a while. Right.
Well, that's the thing, though, right? Is they are expecting it. The market is saying no. We don't believe you.
You go over this, and I got something that I want to share on my computer when you're done going through this.
All right. So this is basically what the Fed is saying. Federal Open Market Committee is saying the rate is going to be at the end of the year. This is essentially stating we're going to hike rates one more time at the next meeting next month, and then we're going to hold them steady. And what the market is saying is, no, you're not. You're going to cut rates, right? So futures markets are saying, you know, the federal funds rate is going to be at 4 points. So, they're disconnected by about 75 basis points. So the Fed says we're going to hold steady. The market says we bet you're going to cut rates 3 times. Okay. And we're in the camp of the market is wrong. Okay. Now, which is not a very bold claim to make, because technically the history of the market is that it's almost always wrong as far as where our interest rate's going to go. So what this is an incredibly busy chart, but I will anticipate to, or I will attempt to explain it. The red line is what the actual federal funds rate is. So this is what the benchmark interest rate is set at. All of these little kind of black dotted lines. This is at any given point in time, what futures markets are saying rates are going to be in 1 year, what the trajectory of rates are going to be in 1 year. So as you can see, there's a major disconnect that a lot of these points of like where the market thought rates were going to be and where the rates actually were. So this is not new that the market tends to overestimate the trajectory of rate hikes, overestimate the trajectory of rate cuts. And the fact that the market is pricing in so many cuts, over the next 8 months here. We believe it's because there's some encouraging inflation data out there, and the market is seeing that, but ultimately that's just at the headline. When you start to strip out the food and energy, when you start to strip out the shelter component, and you start to see that, hey, there's actually a lot of sticky inflation here, we really don't think the Fed is going to back off. And we think that, once again, the market is wrong. And what that means is the market is kind of pricing in a cut. So we think that the overly optimistic viewpoint is likely to be met with some at best some volatility in the stock market. Maybe not a full-blown correction, but we started off the year up 7%. We think it's going to waver a little bit from there.
Yeah, they say if the market's actually right predicting a recession coming up, it'll be the first time the market was ever right predicting a recession coming up. And you can see just by the market anticipating interest rates going up, they've been wrong all along. I got if I can share, I don't know how we can do that. Let's see. Hold on. It's the one I want to share. So some of the things that Dan was just talking about, this is what we call the yield curve. And the yield curve starts at it's 3 months right here and goes all the way out to 30 years. This is what they call an inverted yield curve. And what this is telling us is the Federal Reserve is increasing interest rates here, and the market believes there's a recession coming up. So they're actually pushing down the yield curve. And the interesting part of this has been going up and down over quite some time. This is just over the past few weeks, where this shaded area is where this red line was, where the yield curve was. And what they're seeing is it is possible that we might be living with inflation a little bit longer. And if I spread this all the way out, you can see where the yield curve was along a while back. So it's much steeper now than where it was. And with interest rates going up and down like this, it can happen in no time at all, especially when some numbers come out on inflation, some especially payroll numbers and wage growth. This red line had dropped. They came out with a wage growth miss, I think, and wages were going up more aggressively about a month ago. This dropped way down. And they talk about the 2-year volatility too. This 2-year volatility, this is never that volatile, but it is now. So volatile. I had somebody I was talking to not too long ago. We anticipated putting him into 5% CDs in the 2-year, or 5% Treasury, and it went from in the 5% range very quickly down into the just below 4%, and now it's starting to work its way back up. But this is basically the market saying that there's going to be a recession. We don't necessarily believe that the Treasury or that the Federal Reserve is going to keep interest rates up. And then, just by the fluctuation of this, it shows the inconsistency or the unknown of what they really believe. So I just thought that was an interesting piece of information that we can share. And if you look at this all the way back in 2001, you can see that yield curve as the market dropped down and we went into more of a recession, that yield curve steepened out. So, as we come out of that recession in 2002, the interest rates start going up again, and as does the market, and we go into an inverted yield curve, which shortly after that, in 2007 came along and dropped it way down. So this yield curve, where we are today, has a ways to go. Either short-term rates are going to come down, or medium to long-term rates are going to go up and start slowing things down quite a bit. And Dan, I think this adds to, what's down the road in your comments coming up in the next couple of slides of slower growth over a period of time.
Yeah, so I think the best way to explain that is, if we just go back a couple slides, stock investors are optimistic, risk on, right? NASDAQ is up 17%. Oh, great, there's nice inflation data. You know, the Fed is going to start decreasing rates. The chart, Rick, that you just shared is bond investors, and they're saying, no, there's a recession coming. So stock investors and bond investors disagree to a pretty big extent right now. They're pretty much on complete opposite sides of the spectrum. You know, there is one, you know, and again, stock investors are a little different. Stock investors tend to be more optimistic. They usually try to price in a better tomorrow. There is one thing, though, that is happening, which I don't know if it's being ignored, or if it's just simply being glazed over by stock investors. There is currently the beginning of an earnings recession in corporate America. So you can actually see on this chart here on the left, all of these green bars are earnings recessions, and typically earnings recessions are not short-lived. They're typically a couple of years of earnings recessions. We just entered into one, even though the consensus estimates from analysts are that we will bounce out of it. But, you know, when we talk about the banking issues that are out there, when we talk about interest rate issues, and you know, that we see interest rates staying high, you know, one of the things that comes to mind for us is, what exactly is the tailwind that would have earnings come out of the recession that kind of just started, right? So typically these things are not, you know, a one year and done. Usually it takes a little bit for corporate earnings recessions to kind of
work its way through,
you know, come out the other side. But ultimately, we're starting to see some cracks in the equity market from a more fundamental perspective. You know, and we're talking sort of macro from an economic perspective, but in corporate America, you know, typically an earnings recession, and granted, we don't have to have an actual real painful economic recession. We could just have an earnings recession, which would make a lot of sense. It would just mean that it's going to be harder to get returns in the market. And right now, the optimism that we're seeing is unfounded because the fundamentals just aren't there. Right. But ultimately, you know, just to kind of start wrapping this up here a little bit, we think this kind of spells a long road ahead. So, you know, stock and bond investors currently are in a major disagreement about where this market is headed. You know, we think a lot of that has to do with, you know, how stock investors are interpreting inflation data, how stock investors are interpreting Fed speak, and where interest rate policy is going. But the fact that corporate earnings are entering a contractionary period and capital is getting more expensive and potentially harder to get lead to, you know, put that on the backdrop of banking system issues, and add in some kind of, you know, just X factors, you know, extraneous events like, you know, escalations in the Russia-Ukraine conflict, you know, tensions with the you know, relationship with Taiwan and the Western world, or sorry, China and the Western world over Taiwan. We think this all spells a slow growth environment that ultimately will become one of lower inflation and lower interest rates at some point. But we think that the lower interest rates are not going to necessarily stifle the type of explosive growth that we saw over the last decade plus, that the low interest rates are going to be because of the contraction that will inevitably happen. The question is more so, and you know, we keep going from hard landing to soft landing to no landing to soft landing. It's just how painful is that going to be? But there has to be a contraction ultimately.
Yeah, and that takes, I think the last time we experienced that slow growth environment was back in 2000 when the tech bubble popped.
Right.
And
And again, I don't want to make it seem like there has to be a bubble pop. I think we often think about these, sort of like recessions as the bubble bursts and there's a, big pain. It doesn't necessarily mean that that has to be the case. I actually think most of that already happened last year.
yeah,
But, ultimately it's going to be harder to get growth. We see, the dividend stocks, fundamental analysis being a lot more important moving forward. But I think, and Rick, you had a good comment on this, but I wanted to, there's been a lot of sort of, I don't know, uncertainty and sort of uneasiness in the markets. And I wanted to just sort of take the viewpoint a little longer term, not even that much longer. But ultimately, what this slide is showing us is rolling returns of stocks, bonds, and a 50-50 portfolio. So from 1950 moving forward, if you were invested in the stock market, any given 1 year period, you would have anywhere between 47% upside and 39% downside in any given 1 year period, and everything in between. The important thing to notice here is that a 50-50 portfolio, half stocks, half bonds, in a 5-year period has never lost money. Now, we've just exited a historically bad bond market, and we are only about not even 12 months in the rearview mirror, the peak of the stock market. So the point is, I think right now that we don't see a catalyst for a quick snapback anywhere. But ultimately, and so it could be a long road ahead, which is kind of what we said in the last slide, and kind of gave some reasons why we see it that way. So it ultimately could be a long road ahead. But over the last 70 plus years, any given 5-year period, if you just stick to your asset allocation, you'll at least get back to where you were and then some. Right. So that's really the message. And I think a 5-year period isn't all that long, whether you're in your 30s and 40s and still accumulating for retirement, or if you're in your 70s and taking retirement income, right? A 5-year period isn't all that long of a horizon to look at. That, a long road ahead that's where it may take to get back to where we were back when the market, peaked in the first quarter of 2022.
yeah.
Right. As long as you just stick to your allocation.
And if you, I mean, where I can see that breaking, Dan, is if we go into that recession somewhere around mid to end of 2024, and let's say that recession may not be a deep recession, but it's a little bit longer than what we expected. And and the Fed goes through the reducing of interest rates. And as the Fed reduces interest rates again, we start going into more of an inflationary environment again, because with our population where it stands today, is we have a lot more people going into retirement than we do have people coming into the marketplace. We do have a population, the population coming up now, which it's not population X, what do they call that? The millennial population, which is much larger than what they call the baby boom generation. But the baby boom generation is basically going into retirement at this point in time. And this has actually been happening since 2018. And with we've been starting to get a little bit more aggressive since 2018. And with the pandemic, it pushed people out even faster. But ultimately, it's going to continue to happen. And if we do go into that recession, we bring down interest rates a little bit, and all of a sudden inflation goes up because wages go out of control again, we could very easily see that another increase in interest rate environment within this 5-year period, which actually could bring that 1% over 5 years could actually bring it to a negative over 5 years. And that happened. The last time that happened was in 2000, and I guess it was 1999. We had the peak of the tech at that point, and then we went into what they called the tech wreck in 2000, and then we came back up again, and we ended up in another recession coming in 2008 and 9. And if you looked at that picture at that time, and again, it's when you look at the picture, that's considered the lost decade, where you look back from 2009 and say, you know what, the S&P is exactly where it was in 1999. I really didn't make any money over that period of time. This could happen if interest rates adjust, if the interest rates adjust when we're getting another inflation hike coming up in 23, 24 timeframe.
Well, I think that's the bigger thing is I think it's actually stocks are always expected to be volatile. It's that this downside on the bond, the biggest downside on the bonds actually just happened last year. So unless the bond market snaps back, which, you know, of course that could happen, we don't really know exactly how that factors into the 5-year rolling return over the next 5 years, right? But ultimately, I would still say the better thing is stick to the allocation, simply because typically what happens after you get a period of aggressive rate hikes is eventually rates are going to come back down. And we believe that that will happen once you get into a recessionary environment. So it doesn't mean it's going to be next year, but in the next 2 to 3 years, we should see rates come back down, which should be good for bonds.
Correct. Not necessarily
so ultimately,
for the economy, but good for
yet to be
bonds.
seen. But I'm sure that will be covered on a future installment of this. I'm gonna just move. We're actually at 5. So if anybody, we had a couple questions that came in during, and I think we answered them during the conversation here. But if anybody has anything else, you can just, you know, pop them in the box here. We'll hang on for a minute. Thank you so much for attending. And if there's anything else, you know, outside of here that you'd like to talk through, just, you know, give us a call or send us a note.
Yeah, and while we're waiting, what was that? What were we talking about earlier about what we could be talking about next in our next quarterly conversations?
Oh, the national debt level.
Yeah, okay. Because that's something that everybody's talking about now. So it's going to be an interesting quarterly conversations.
Yeah. So I was trying to see if that could, you know, come into this one or the, you know, or the letter, but I couldn't. Yeah, it didn't go with kind of what we wanted to address here.
Well, I think what we addressed is more important than that at this particular moment.
Well, yeah. But I think that, yeah, that probably will be something that we're going to talk about potentially next time.
So, well, I want to thank Dan again. Great conversation. We appreciate what you put together. The letter was fantastic. I appreciate everybody for joining us today. You know, we'll just keep our eye on the market and keep moving forward with where we are today. So thanks again for joining us this quarter. We look forward to seeing you again next quarter.